You're watching CFD Trading Insights. I'm Mark Lowdy. Our guest again today, Alex Douglas from City Index. Alex, tell us a little bit about the cost of trading CFDs. Nothing's for free. There's no such thing as a free lunch. What are the charges involved?
Well, in comparison to equities, the charges are, in fact, one of the other big advantages you have when you're trading CFDs. Comparatively, the costs are significantly lower. If we start by talking about the trading platform itself, you have access to our advanced trading platform and a full suite of charting tools, all for no charge whatsoever. So if you open an account, you have access to these tools. There is the potential for a small charge, a monthly charge of $38.50 if you just open your account and use it to access live prices without ever doing any trading. But as a rule of thumb, if you have an active account with us, if you're trading 4 or 5 times per month in any security, we will absorb that ASX access fee. So in effect, our active traders pay nothing to have the platform.
And that applies to equities. What about other asset classes?
Well, the one platform gives you access to all different asset classes. So if you have the platform, you've got access to all of the markets that we offer, and you pay no extra fee for the platform. There are commissions, though, payable if you're trading equity CFDs. The commission that you pay is 0.1% of the face value of the trade, with a minimum of $10. Effectively, this means if you're trading a position that has a face value of $10,000 or less, you'll be paying $10 commission. If it's more than $10,000, you'll be paying 0.1%. Now that commission only applies if you're trading equity CFDs, but if you're trading commodities or indices or foreign exchange, then you're not paying any commission at all.
All right, well, give us an example from on the equity side then about what sort of fees might apply. Okay,
well, if we have a look at an example of the comparison between trading CFDs versus trading shares, we can see how these fees stack up. If we look at a company called XYZ, we want to buy this stock. It's currently trading at $5 and we want 2,000 of them. Now, if we want to trade, though, of course, the face value of that is going to be $10,000. If we're trading CFDs, we'll be paying a commission of 0.1%, or in this case, $10. If you went to a discount broker, you may be able to find a broker that would let you trade for, let's use an example of 0.25% or $25, which is probably not bad for discount broking. Now, in terms of CFDs, if this particular stock, XYZ, trades on margin of 10%, which is fairly typical for equity CFDs, you would need to have $1,000 upfront available to take this position, $1,000 in your account.
That's right, because you don't need the full amount of the shares.
Exactly, because we're trading on leverage. However, if you're trading shares, you need to have the full $10,000 face value to settle the transaction.
So it costs you more and you need to have more money to start with.
If you're trading equities, yes indeed. Now, because you are trading a leveraged product and you only have to put up a small fraction of the face value, there is a financing element involved in all this. If you take a long position, which means you buy an equity and then hope to sell it at a higher price, you will be charged a small financing rate. Now, this works out to be, it's the RBA overnight cash rate plus or minus 2%. So if you have a long position, you'll be charged the RBA rate plus 2%. If you go short, you will actually earn a financing benefit, which is the RBA rate minus 2%.
Okay.
Of course, you don't have that if you're trading physical shares, but you do with CFDs. On the flip side, of course, if you're trading physical shares, equities, you're going to be paying GST on whatever brokerage you pay on commission. Of course, you don't have that with CFDs.
Right. So you have a higher outlay with equities, that is the underlying. You have a higher commission rate, but you also need to stump up all the cash up front and get hit with GST in the process. Okay, so that's at the open. What then happens at the end of trade?
Well, let's suppose we're looking at this a couple of days later and the price has risen to $5.30 on our $5 stock. So everything's going well for us. The face value of the trade is now, of the transaction, is now worth $10,600. If we go to sell our CFD position, again, 0.1% commission, so we're looking at paying $10.60 to close out the trade. If we keep the same commission rate on the shares, we're looking at 0.25% or $26.50. So again, you're paying more to close out the position. You don't pay any GST, of course, on the CFD commission. You do with physical shares, so this time you're paying $2.65. Now, the financing that we looked at. For a single day, we were looking at the RBA rate plus 2% because we're long. So if the Reserve Bank rate was 3.25%, for example, you'd be looking at paying 5.25% to hold that position overnight. Now that's not 5.25% per night, that's on an annualized basis, so 1/365th of 5.5%. So it's a very small amount. Now if you've held a position open for 3 days, that would be 3 days worth of financing. So if it was $1.44 per day on our $10,000 position, you'd be looking at paying about $4.32 for 3 days worth of financing. Now, when you add up all of the costs of the CFD transactions, so the commission to open, commission to close, and the financing, it's cost you $24.92 in costs. So if we look at the $600 profit we've made on the trade, take away the $24.92, we're left with $575.08 of profit. Looking at the physical shares, we've had significantly more expenses in terms of brokerage to buy, brokerage to sell, GST on both of those. Total costs there have been $56.65.
More than double.
Considerably, yes. So by the time you end up looking at the net profit, you've only got $543.35 on your physical shares.
Well, I mean, overall, that doesn't actually sound like that much of an amount of difference, does it?
It doesn't, but every little bit counts, of course, when you're investing. But one of the key things, of course, is that in order to achieve that larger profit on the CFDs, you only had to put up a fraction of the face value of the trade.
$1,000, if I remember right.
$1,000 to make a profit here of $575.08. So you could say that you've achieved a return of 57.5% on that trade. With the shares, however, you've made $543.35, but you had to put up the full $10,000 to achieve that result. So in terms of profit there, you've made 5.43%. Either way you look at it, the bottom line is you have made more profit by trading the CFDs because the costs have been lower. And because you've only had to put up $1,000 margin to take this $10,000 position, you've got more money left in your account to take advantage of other opportunities.
Thank you very much, Alex Douglas. And you can interact with us through this website. Click Apply for a demo account to try the City Index platform risk-free and discover the features of the live account. Or click here if you want to jump right in and apply for a live account straight away. To learn more about CFDs, download the 10 Golden Rules of CFD Trading by clicking here, or ask us any question you like about CFDs through this form.
You should read and consider the PDS before making any decision to deal in City Index products, which are derivatives. Derivatives can be highly leveraged, they can carry a high level of risk and are not suitable for all investors.